What is up, YouTube? It's your boy Shabby Shambles here. You know we have to talk about those Nvidia earnings that just dropped. They did not perform as badly as I had been expecting, but they still underperformed on some key metrics. Let's drill into it. Remember, like and subscribe, and stay tuned. Alright, let's dig into this. This is some juicy stuff. Now, the revenue is down from, when is this from? From last year, around this time. It's down, I think they said 17%, which is not great, but maybe to be expected with the demand shortages cited by Intel and AMD, with the macro economy, with supply chain shortages coming out of China. I do think that some of this revenue shortcomings have been priced in just by the macroeconomic trends. And worth noting, they don't show it here. I couldn't find numbers where they showed guidance, but they did actually beat guidance on revenue by $200 million. This is in millions right here. They didn't make 5,931, but 5,931,000,000. So they actually beat their revenue estimates by $200 million, which is maybe encouraging to see. But having them down year over year, even in this macro economy, is not the best thing, clearly. So let's drill down into the operating expenses. Research and development is up. Sales general administrative is up. And I like seeing research and development being up. I like them saying, all right, we don't have a ton of revenue incoming. We don't have, we're experiencing a revenue shortfall. Let's try to dig in and make the best products that we can make. Right? That's what this number, the change in this number really is to me. They're seeing the revenue come down and they're saying we need new products. We need to improve the products that we have. We need to improve our product offerings. And this to me is a really bullish sign on the stock, right? In the long term anyway, in a year or two out, because it means the stock is serious, right? It means that they're not seeing these numbers and investing in more sales and more customer-facing applications. They're going internal and they are taking a hard look in the mirror and they are saying, what can we do better from a product standpoint to meet our goals in the future? And I really like to see this. I like to see any company that's not doing that well in terms of revenue year over year. I like, especially these technology companies, I like them going back, reaching into research and development and saying, we need to bring the best products that we can possibly bring to market. We need to improve our product offerings. That's a really, really good sign from where I'm coming from. Because there's a lot of extraneous stuff that goes on with these companies. There's sales and there's admin costs and there's all this other stuff. But if you, at the end of the day, if you don't have good products, it's gonna catch up to you eventually. You can have the best salesman in the world. You can have the best administrators in the world. If you do not have good products that are built to compete, you will get left behind. Now, let's move on. We see income from operations down, interest income is up. Income before income tax is way down year over year. Net income is way down year over year. This might be due to the demand shortage that Intel and AMD were citing. That could be the case. I think there's reason to think that's going to improve in Q4. Um, Not that Nvidia, Intel, AMD are going to, sell a ton of products going into the Christmas season, but if you are a computer manufacturer, right, you might be building your computers uh, a year in advance. This might be a cyclical thing, I guess, is what I'm trying to say. That they might have a down quarter before the computer manufacturers look to develop next year's computer using their chips, right? So that makes sense to me that there's this demand shortage going into Christmas, and then the computer manufacturers release their products for this Christmas season, right? Or the cell phone manufacturers or all that release their products for this Christmas season and look forward to the next Christmas season, right? Um, I don't know if that's the case. That is just my thought process looking at that number. Um, I'm gonna be keeping an eye on it in future quarters, but I do think that there's reason to believe that it might stabilize and even push up going into Q4. Now, earnings per share are, this is income per share. Looks like the same thing. We gotta scroll up for earnings per share though, because we just have it. We have the top line numbers available up here. Here they are. So this earnings per share number is one that I really want to talk about. It's up from last quarter, but it is well below their guidance for this quarter. I think guidance, again, we can't see it for some reason, but I think guidance was 67 cents per share, 69 cents per share, and they missed it. They missed it. Um, and what that really means, and again, this might be the demand crunch that we're seeing out of Intel and AMD. But the fact that this missed guidance so much tells me that it's not a cyclical thing. It's not a thing that they were expecting to miss earnings that much. And this may have to do with some of the tension in China. This may have to do with the contraction of the economy. This may have to do with the bear market going on longer than expected. More than likely, it has to do with all three at the same time, right? As these things go, it's a pretty complex assortment of things. But uh, I I think that this is one of the top line numbers to keep a really close eye on going forward. If they can't deliver earnings per share the next quarter or two, and I said that I have a bear case against Nvidia, and I do have a very, very thorough bear case against Nvidia in the short term, but missing earnings per share by this much, especially missing guidance by this much, is troubling because it means the company isn't on sure footing as far as investor relations go. I was expecting down revenues, right? I was expecting down gross margin, elevated operating expenses. I was not expecting diluted earnings per share to miss guidance. The fact that it missed guidance is somewhat troubling and a thing to watch going forward. So that's one thing I'm going to be keeping an eye out in Q4 and Q1 of next year. Let's talk some more about these numbers. What is the other one I wanted to? Yes. So Their cash on hand is down. Their cash on hand is down. Now, they still have a sizable chunk of cash in the bank. Don't get me wrong. But the fact their cash on hand is down, coming out of, or hopefully, fingers crossed, coming out of a bear market. We talked about this with Palantir. You want to see the company's cash growing coming out of the bear market. It's going to allow them to purchase more assets at a cheaper price. And this again points to a company that is maybe on less sure footing than we thought, right? It points to a company that is maybe having short-term troubles that they did not anticipate, and is in a little bit of a moment of tension, right? I don't know if that's what's going on. There are plenty of reasons that cash could be down. Cash is down, by the way, by a substantial amount. I mean, this is $8 billion. I'm wondering what they spent that cash on. They might tell in the statements above. It looks as though they have... No. I can't really tell from these numbers. Inventories, maybe? Maybe they just have a lot of inventory. Oh, this could be the demand crunch. This could be that they didn't anticipate the demand crunch. So maybe the demand crunch isn't cyclical, right? Maybe this is totally just catching them by surprise. And so they invested way more money into inventory than they should. And that's not covering the whole balance of cash that's on hand. But also revenues are down. They have to find a way to meet their obligations and do all that. So maybe they reached into their petty cash fund and are using that to fund some things while revenues are down. That's plausible. But it also points to me, especially since revenue was above guidance, it points to a company that is, again, a little bit uncertain, a little bit shaky as to what's going on in the broader markets. Increase in liabilities. Not a ton of increase in liabilities, but that sort of makes sense. Again, revenues are down, bear market, etc., etc. Nothing to really write home about here. And the total liabilities are actually down. Or the total liabilities plus shareholder equity is down. The total liabilities are actually up. Alright, so I think that was most of what I wanted to talk about in the numbers. Now let's go over their statements here. The outlook for next quarter, revenue is expected to be $6 billion. Gross margins are expected to be 63 and 66. What are they this quarter? So gross margins are going up, way up, quarter over quarter. Okay. Operating expenses are also going up. That's non-GAAP. No, they're staying relatively consistent. Okay. You like to see that. You like to, because if operating expenses remain consistent, yeah, that's something that we like to see. Because if operating expenses are remaining consistent, that means the company's sort of stabilizing, right? They're not spending so much on operations going forward, which is good. right? Like seeing this number and then seeing it jump and jump. You know, it's up 30% since last year. And operating income is down since last year. It's kind of like they're dipping into the operating income to cover operating expenses. It's understandable, but I like that it's stabilizing. Tactics. All right, so third quarter revenue on data centers was up 31% from a year ago. This is big. This is big. The data centers being up 31% from a year ago. That's big. Data centers are a really big part of they're a really big sector within the market. Basically, these companies go around to data centers and they might have right. So this is talking about the adoption of their chips at cloud data centers. Specifically, they have, you know, Microsoft helping with Microsoft Azure, helping with the world's fastest supercomputers, um, etc., etc. This is kind of akin to F1 for car companies, right? Where you get out there and you showcase what your technology can really do for cutting edge technology. Right? You see AI software, AI model cloud services, all these sort of cutting edge technologies are adopting Nvidia, right? Um, Visualization, gaming, down 51% from a year ago. So I have some things to say about this. So why is gaming revenue down 51%? That this is something that has to do with demographics, right? This might sound a little bit technical, but the millennial generation, my generation, is aging out of gaming, right? So I think we're gonna see for a lot of these gaming, uh, a lot of these gaming segments in these companies, they're gonna be down until they sort of reach that threshold, because the millennials were the children of the baby boomers. The baby boomers were huge. Gen X was a smaller generation, a much smaller generation, and then the millennials, who are the children of the boomers, were again huge, right? And then the next generation down, Generation Z, is smaller than the millennials. So where the millennials were gaming, you saw a lot of spend on gaming, a lot of companies getting a lot of income from gaming because it was this huge generation that was playing these games, and now it's starting to retract, both because less people are gaming because millennials are spending less time gaming and more time at work, less time gaming, more time just watching Netflix, and I think that there's more competition too in that space from Netflix, from TikTok, from all this entertainment stuff. But so that's what I think is going down there. I don't think that that's anything to worry about. I think that's a natural contraction. And I think that that's going to stay where it is and kind of remain solid, but not a major player in their revenue growth going forward. Now, visualization down. This I don't really know anything about. I mean, it's cloud services for artists, developers, and enterprise teams to access metaverse applications. Your guess is as good as mine. That's a whole bunch of buzzwords in one sentence. I am certainly not an artist either. Let's see. Automotive and embedded. Third quarter revenue was up 86% from a year ago. This is really encouraging to see. Really, really encouraging to see. I mean, it's a matter of time till we have autonomous vehicles. It seems, and getting your hardware embedded into these vehicles is going to be a big player going forward, and I'm glad that they are designing this product suite for these vehicles, and I'm glad that they are really making a play for this segment. It's good to see. Now, I mean, revenue is $251 million. That's not an appreciable chunk of their revenues yet, but I think in the future, as we move forward, it's going to be for sure. Now, the CFO commentary. Let's see what he's saying. Okay, we don't have that yet, or we do, but it's not on the page. We're gonna scroll down here and take a look. Yeah, that's most of what we have. But let's see what the CFO said real quick. The world leader in accelerated computing, corporate profile, quarterly results. All right. I can't find what the CFO said. Chances are it was mostly going to be the normal sort of rah, go us, we're so good, buy our products, this is why they're great, sort of sales pitch thing that most C-suite executives have to come out with because they're investing in the company. Nothing wrong with that, but not a lot of meaningful information to be found in that statement anyway. The earnings calls really do live in the numbers, and if you want to invest and if you want to learn about this stuff, you gotta learn to read the numbers. That's where the tale really lives. That's where the story really lives, and what they are telling you is what you have to listen to. And what I'm seeing from the numbers is a company that is looking for its footing. They're playing in some of the most cutting edge industries. They are seeing growth in some of the most cutting edge industries, but they really are maybe a little bit unsure of themselves from an accounting, from an accounting perspective, right? There's a little bit of uncertainty, a little bit of a hiccup in their supply chain, in the inventories they have on hand versus the demand that they are seeing. Not a huge deal at this point. Could happen to anyone. Who knows why? These supply chains are very complex. They may very well have ordered it all before the bear market started, anticipating the bull market to keep going. Then the Fed came out and killed the bull, and they were stuck with 4,000 chips for however many chips that they didn't need. They just had them on hand, and now they're sort of scrambling to do something with them. I mean, that's not a huge deal, but we want to see them solve these problems going into next quarter and going into Q1 of 2023 for sure. I mean, I guess it's 2024. They were reporting for third quarter fiscal 2023 already, even though 2023 is next year. But far be it from me. Q1 of next year. By Q1 of next year, we really want to see this company stabilize and sort of come to a point where they sort of are have a better grip on their supply chain, have a better grip on the supply demand cycle in this market. Again, things have been kind of all over the place. Completely understandable. We know that we're hearing the same things from Intel and AMD, but it does seem there's a little bit of uncertainty in the company, um, which is cause for long-term, um, a little bit of long-term shakiness, a little bit of long-term uncertainty. In my bull case on the company long term. Now the bear case in the short term, um, I think they did exceed their guidance on revenues, and that's going to buoy them a little bit. But I think in the next week, in the next 2 weeks, as investors start to come to grips with some of this stuff, I think we're gonna see their share price come down. I mean, it's just so overinflated. Um, and how are you going to pay 40% markup on what it was a month ago when revenues have fallen in the last 3 months, right? It just doesn't make any sense that it's up that much in the last month. So from an investment perspective, I mean, and I've said this the whole time, like long term, this company's great. Not hating on the company long term, but short term, uh, they gotta come down. They just like they're too overinflated. It's it's just math. You can't the company is not worth 40% more than it was in Q2. In fact, it is worth 12% less in terms of revenues than it was last month, or last quarter rather. So that's really it. That's really all I wanted to talk about. I do think that I was a little bit surprised that they did okay. They did okay on earnings, which was good to see. I think there's a little bit of uncertainty in the company, but that's not something we have to react to and sell off all our stuff that we got. That's something we have to keep an eye on. We have to keep an eye on it going forward. So that'll be it from me. Remember to like and subscribe. Thank you for tuning in. I hope you found it as educational as I try to make these things when we go over earnings. And I will see you tomorrow.